Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm going to take a quick look at Realty Income, ticker O, and more specifically their acquisition of Spirit Realty, ticker SRC. Realty Income, the monthly dividend company, is down about 4.5%, 4.3% off the back of this acquisition. And SRC, as the company being acquired, is up 9.4%. So not a huge bump on that. Not a huge premium to the acquisition. As always, guys, please do your own due diligence before making any investment decisions. This is not financial advice. So why is Realty Income doing this? I talked about this in another video. Realty Income is big, and in order for them to grow, they need to make sizable acquisitions at this point, and this is one of those. They did one in 2021 when they merged with VE REIT, spun off some of those office assets. In 2023, they did asset transactions in that 1 billion, 1.5 billion range via some sale leasebacks or portfolio acquisitions. And they've basically been acquiring 5 to 10 billion a year in assets in the last year or two. And this is just a continuation of that. They're going to acquire another $9.3 billion company that is going to close in 2023. And SRC is a smaller player in the triple net lease space, but this only makes bigger. And this is an all stock transaction. One of the reasons the market probably doesn't love this dilution of this scale isn't always beloved by shareholders. It's 0.762 shares of Realty Income for each share of Spirit common shares. So if you're a Spirit shareholder, you're just going to get Realty Income shares unless you sell right now once this deal closes. It's about 13% dilution because Realty Income shareholders are going to own about 87% of the company. 13% will be owned by Spirit shareholders. And the nice thing is it's going to be immediately accretive to AFFO for Realty Income, but it's only about 2.5%, and that's after the synergies that are expected from back office elimination, etc. And that might not sound like a lot, but certainly something. It's certainly a way for Realty Income to grow. It might, however, show that their upcoming earnings are going to need something like this to really boost growth going into 2024 and 2025. Their earnings are about a week, so we'll hear more about that, but it is a question mark as to the timing of the acquisition. The nice thing about this is that if you look at the valuation of Realty Income, and this is really one of the reasons they're doing, the market is giving this a 12x multiple. So investors may say, well, this is as low a multiple as it's ever been. Why are you diluting now? Maybe not ever, but as long as it's been in a while. Why are you diluting now? Well, the reason for that dilution is because the market is still giving this an 11.5 to 12x multiple, depending on the day, whereas the company they're acquiring is getting about a 9x multiple, maybe 9.5, 10x multiple after today's boost. It's still, the cost of the company is still lower than the benefit that Realty Income is getting, which is why this is immediately accretive. There's a premium to the deal that they're making. So this is the transaction rationale. It's, again, immediate AFFO accretion, which is good due to the premium that they're getting and the cost synergies. They do get an attractive capital stack. The debt that SRC has is actually pretty good. It only has an average cost of 3.5%, but it is only a term of 5 years, which means they're going to potentially have to refinance that in the next couple of years, which may be tough, although with the debt rating that Realty Income has, won't be as bad as if SRC had to do it on their own, which is probably why it was getting a smaller multiple. Still getting a good balance sheet. They don't have to issue any new capital, any new debt rather, besides the shares. And it becomes the fourth largest REIT and one of the largest triple net lease REITs, well, the largest triple net lease REITs. And you can kind of see that this immediate accretion is basically due to cost savings and the multiple differential that you are getting from the transaction. So it's going to be over 2.5% per share accretion to shareholders. So why does the market not love this? Well, anytime there's a big deal, there's a lot of questions around it, questions around why they're doing it. And really one of the reasons that the market is questioning this deal is probably because the portfolio that they're getting is probably a bit worse than what Realty Income currently has. Realty Income currently has about 40% of their assets in investment grade clients, whereas Spirit is only about 19%. If you look at the leases that Spirit has, I'm going to go over here to their last investor presentation. 78% of the leases have fixed or flat. Well, 78% have fixed increases on their contracts, 10% are flat, and only 13% are CPI related. So there's going to be a lot of that to be changed in the next couple of years, and more than 50% of that is really 10 years out. So kind of going to be locked in for quite some time as we go back to this deal itself. The nice thing about this deal is that Spirit's portfolio does have 99% occupancy, and also it's about 26% industrial, which is kind of a benefit to Realty Income in my mind. Industrial always kind of gets a better multiple than retail. And at the end of the day, as you combine these companies, even though it's only 19% investment grade, because Realty Income is so large, they can kind of swallow these smaller companies without it impacting the overall portfolio all that much. So only 19% investment grade assets for Spirit Realty, 40% for Realty Income. But when you combine them, it's only a 3% reduction in investment grade assets for Realty Income. Industry concentration becomes a bit lower. Top 10 client concentration becomes a bit lower. Occupancy gets better. Obviously, rent gets better. So pretty solid acquisition in my mind from a lot of perspectives. You get more industrial than you had in the past. There is a bit of overlap in terms of some of their retail clients, a good deal of overlap, really. You can kind of see that, hey, Dollar General is now 440 basis points higher, so is Walgreens. And as you look at some of these assets, I would certainly think that the assets that Realty Income has, as far as their top 20 clients go, is just better than the top 20 clients of SRC. You can kind of see that they're very in the Lifetime Fitness, At Home, Dave & Buster's, Church's Chicken. I don't even know half these things. Like if I look at, would I be surprised if something like At Home, which is a store, right? Home decor. If that went out of business, no. Dave & Buster's, if that went out of business, no. Zips Car Wash, Walgreens, and CVS, which Realty Income already has, just announced a bunch of closings. Party City. Are there bankruptcy potentials here? I think so. With retail, it's always hard to tell, but in general, retail isn't as good as it was 20 years ago. So when you talk about, well, Realty Income has had fantastic long-term returns going back to 1994. Well, a good portion of that life cycle was when retail was really amazing, right? They didn't have Amazon to compete with. They didn't have online stores to compete with. That's changing a bit these days. So is retail all that enticing anymore? I don't think so. On top of that, you get some of these assets that are kind of in that office space, in that country club space, in the medical space, in the flex data storage and hotel space. Will Realty Income sell some of those or keep them? Who really knows? But it's certainly a bit of a different portfolio. Some would say a slightly worse portfolio, and that is potentially why the market is giving this stock a haircut today. To me, this doesn't seem like that bad of a deal. This is essentially what Realty Income is going to need to do to grow going forward. They are now a 60 billion plus company after this acquisition. If they need to acquire 6 to 10 billion in assets every year, how the heck are they going to do that? You know, one way to do it is to do deals like they've done with the big casinos in the past. But with cost of capital going as high as it's gone, they need to really get better cap rates on some of these deals. And a deal like that comes at a pretty good cap rate. If you kind of think about the multiple that the market is giving this, the multiple that they're paying, they're getting essentially a 10% AFFO yield on something like this, which again, they're paying maybe a 9% AFFO yield for that, but there's still a spread between the cost of capital versus the benefit that they're getting off of the market multiple premium. The risk here, as I talked about in the videos before, is now that there's more debt that needs to be refinanced. There is going to be more operating cash flow due to the acquisition, but they're still not going to have all this cash flow to pay off all this debt as it comes due, especially in 2026. They're going to have 4 billion in debt due. Their operating cash flow in excess of their dividend is probably going to be in that 1 billion range, which is pretty good. But as they look at this debt, they're going to have to at least refinance, a billion here, a billion here, a couple billion here. And as their current interest rate is kind of in that 3.8% range, it's going to go potentially to 6 to 7% when it has to be refinanced. And that's going to be a tough pill to swallow when it comes to the cost increase to the bottom line in relation to the interest expense they pay now versus what they're going to pay in the future, which is going to impact that operating cash flow in excess of the dividend. Not saying it's going to put the dividend at risk or anything like that, but it's something to keep in mind with all REITs, not just Realty Income, especially ones that have a lot of debt coming due in the next couple of years. Obviously, the benefit to holding something like this at a multiple like today would be huge if interest rates start coming down, but if interest rates stay elevated, there's certainly going to be pressure on their AFFO and even their AFFO growth. And I could see a lot of these REITs start seeing AFFO shrinkage due to the fact that their bottom line is impacted so much by these maturities maturing and being refinanced at much higher interest rates. Now, some of that is going to be offset by the fact that a lot of these rents have built in 2% escalators. As they get renegotiated, they potentially get renewed at above 100% market rates. In the last couple of years, Realty Income has been in that 102 to 103% recapture rate, which means that if their rent was $1,000, now it's $1,030 going forward with escalators on top of that. So those escalators will hopefully be more CPI adjusted than the 13% that SRC has right now. So there's some potential upside that is going to cover off on the interest rate increases. But I think AFFO growth is going to be muted for REITs in general if these rates stay elevated. So as far as this deal goes, do I like it? It's fine. I do think the portfolio gets slightly worse, but it gets slightly worse from kind of a subjective perspective. At the end of the day, it's got occupancy that's close to 100%. It's got lease expirations that are, close to what Realty Income is. They can kind of pull them in without impacting their overall portfolio too much. That is the benefit of being such a large company. They can acquire these REITs that are 5 to 10 billion without really breaking a sweat. Because if you're a $10 billion company and you're acquiring a $9 billion company, suddenly that's 50% of your portfolio. Right now, Realty Income is acquiring a $9 billion company, but it's only, 10 to 15% of its portfolio, 20% of its portfolio, whatever the math works out to be. So yeah, the investment grade is lower, but it's only impacting the overall portfolio by 3%. And some of this other stuff is actually improving. It's becoming more industrial, which is a good thing. Industrial gets a better benefit. I think they can sell some of these other slices that they don't really have right now, whether it's hotels or what was it? Or country clubs or medical facilities or data centers. They can sell those off for money to pay down debt and or acquire more companies. And at the end of the day, it's immediately accretive to the AFFO. Get that the market doesn't love this, but if anything, for me, now O is a bit more attractive at this price point than it was in the last couple of months, because now the yield is getting higher. I might actually start nibbling a bit and acquiring a bit more O than I have in the past. I do own O, but I own a very small position. I've been waiting for it to get closer to a 6.5-7% dividend yield before getting a bit more. I don't think they're at risk for a dividend cut, but I think, looking a couple of years out, if interest rates stay elevated, I think there's going to be certainly more dividend cuts in the REIT space than there have been already. I think if you look at some of the earnings of triple net leases that have come out in the last couple of weeks, whether it's Vici or ADC, they've been pretty positive. And now Realty Income has its earnings in the next couple of weeks. I think actually a week from now, I'm going to be looking out for that and seeing what they say in addition to this acquisition, what they guide for in 2024 AFFO. Right away, you should at least expect 2.5% AFFO growth in 2024 plus same store growth. So I would say potentially, mid-single digit AFFO growth if everything is working smoothly, given the acquisition and the same store sales that they generally get and some of the other acquisitions they've made. So we'll see what they say. To me, this acquisition isn't as bad as the market makes it out to be. I do think it's slightly diversification, as they call it, diversification and making things worse. Yes, it's dilutive, but it's dilutive for a reason. They're growing. This is what you have to expect as an O shareholder going forward. I think every couple of years, they're going to make these big acquisitions, whether it's probably through issuing shares, honestly, going forward, given the cost of debt and their debt burden already. And as long as it's accretive to earnings and as long as it doesn't put pressure on the dividend, I think investors should be fine with it. And to me, this seems like it's fine. It's not amazing by any means, but it's fine. Right, and that's kind of all you can expect in this type of market for REITs. It's kind of unexpected, honestly, but I don't hate it as a shareholder, and it might actually make me acquire some more shares if the stock price stays in that mid 40s range, especially if it hits a 7% yield. Not going to be a huge position for me by any means, but not a terrible acquisition. So FYI, disclosure, I do own O. As always, guys, please do own due diligence. Please talk to a financial advisor before making any investment decisions. I am not a financial advisor. This is not investment advice. If you guys think differently about O, let me know in the comments down below. If you like the video, like the video down below. Subscribe if you're new to the channel. And as always, thanks for watching and have a good rest of your day. Bye.